Welcome to the Gray Report. I'm your host, Spencer Gray. And if you are a multifamily investor, you're an aspiring investor, an industry insider, or you just like the idea of creating passive income and generational wealth through investing in multifamily apartments, well, again, you're in the right place because we have an excellent episode today of the Gray Report, doing another Gray Report newsletter roundup and recap everything that happened in the multifamily industry, real estate, in the economy for this last week. Right now, it is June 17th, 2021. And like most weeks, but especially this week, a lot is going on. We had Chairman Jay Powell, Chairman of the Federal Reserve, giving his press conference after the Federal Open Market Committee meeting that took place this week. Markets were, I wouldn't say they were in turmoil, but a lot of discussion about inflation, growth, interest rates, where we're going. And so we're going to be kind of wrapping it all up, distilling it down. And again, if you didn't pay attention to the news this week, or you were just, it was going on in the background, we've got you covered for some good analysis, taking a deep dive. So once again, we're going to be bringing on Matt Bosnagel. He's the Director of Communications and Marketing here at Gray Capital. Dr. Bosnagel, how are you doing today? I'm excited to have you on again to break this down. How is your Thursday going so far?
Going very well. Another exciting week, and a lot of things to cover. And a lot of these trends that we were talking about before are really being kind of fully realized now. A lot more people are noticing stuff that we had noticed before in the newsletter. So it's a little bit gratifying for us.
Yeah, isn't that interesting? I feel like we talk about things a couple weeks. We talk about something and then 2 or 3 weeks later, it starts gaining traction. So if you guys want to stay up to date, subscribe to the Gray Capital YouTube channel. That's where these recaps are posted consistently. You're going to get an update. The newsletter goes out Thursday at 8:30 in the morning, and these videos typically get posted around Friday, sometimes Thursday, but typically Friday. So it's basically like clockwork. Subscribe to the YouTube channel and you're going to stay up to date. And then also grayreport.com. That's the real way to stay up to date throughout the day, 24/7. So Matt, again, let's just hop right into the newsletter for the Gray Report, Multifamily News Research and Reports. We've got the Federal Reserve right here, and Federal Reserve meeting affects multifamily. Again, Chairman Jerome Powell, Jay Powell, was discussing inflation, interest rates, the economy, and there's a lot of buzz, a lot of noise, and some opinions that were correct. Some I think were, from what I heard in the press conference, and I watched it again last night, I think some people were hearing a little bit different things from what he was saying. Matt, give us a quick rundown. What is your take? What's the theme for this week's newsletter?
Yeah, it's interesting that these they parse the language and they parse these speeches almost like a modernist poem, like they're trying to figure out and interpret wild meanings. And essentially, Jerome Powell announced that yes, inflation has crossed his mind from time to time. He said, quote, "You can think of this meeting that we had as the talking about meeting." He said, kind of referring to the possibility of cutting back on the amount of bond buying or raising rates. I think that it is consequential. The meeting was very important, and it did move markets for sure. But it's not telling anyone anything that they didn't already kind of know. And in terms of action, not much is going to happen right away, especially in the immediate future. So yeah. It's a little bit of I don't want to say it's like trying to mollify, but I think a lot of what Jerome Powell did was try to assuage the fears of inflation. But that's, I think that in terms of multifamily and commercial real estate, they are arguably in a better position than in the past 2 weeks. Lumber prices have gone down significantly, making new development easier, but I still think that there's a challenge given the still elevated price of steel and other construction materials.
Yeah, no, well, I think those are all good points. And in one sense, like you were saying, everyone's trying to read the tea leaves and read in between the lines of, what is he going to say? Is he going to drop anything? Is he going to go off script at all? And he's very measured. And, obviously, he's leading, the the world's largest, cartel of, of bankers. It's a private organization, the Federal Reserve. It has very little oversight. It's technically regulated by Congress, but not really. And it seems like he almost has a lot of humility in acknowledging that, the Federal Reserve has made mistakes in the past, and they don't know everything. He said, "Wait, he have no idea where the economy is going to go in the next couple of years." What he seemed to be very confident about, though, is that we are seeing, incredible amount of growth, that, we are in full-on recovery and maybe even emerging out of recovery right now, and the economy is going to see a significant amount of strength. The concern is not that we're going to see a crash. The concern is that there's going to be too much strength in the economy. But they learned, back in 2013, then again in 2018, when they hiked rates. There was always the concern that if employment got too high, that inflation would pick up, but that didn't happen back in 2018. And when they did raise rates, it kind of messed up the economy. Same back in 2013 during the taper tantrum. And so they are very hesitant for making any kind of action. I mean, was very clear. They are much more concerned about maximizing employment and getting everybody a job and making sure everybody's got some money in their pocket, rather than cooling off the markets to appease markets. And, again, it's a committee, but we got, kind of one guy kind of, making some major decisions for the economy. And a lot of the articles about, rates are raising, they're going to raise interest rates. He said they're now thinking about it, because without thinking about it, he's going to lose all credibility, because to say there's no inflation right now, that's just factually incorrect. Like, prices have gone up. I mean, inflation is running. I mean, I think annualized rates is close to 6% right now. I mean, they're talking about GDP growth close to 6 to 7%. But if you look at, again, the treasury yields, which we're going to get into, we're not really seeing that huge spike in probably really projecting major rate increases anytime in the near future, so it kind of goes to the narrative that this increase in prices, it's transient. I feel like is not the right word, because a transient is, when I think of a transient, it's a pop, it's a spike, it's a very transient, it's a very short term, it's a blip. I used to be a recording engineer, an audio engineer. I did a lot of mixing, a lot of audio editing, and we look for transients in like waveforms, and it's like a transient is like if someone hits like a snare drum, it's like a pop, it's like a drum hit. It happens very quickly and it goes back down, and little spikes. This is not like a spike unless we're looking at a 20-year chart. This is going to be more of like a pulse. We're ramping up to something, but it makes sense that once we get through some of these supply constraints, we're going to ease out. And he says right now we are on track to hit that 2% average inflation based on these elevated levels of inflation. So he said they don't mind if it runs 3-4%, if it runs hot for the next couple of years. They believe that all of the factors that prevented inflation from taking off over the past decade, those same factors exist: technology, aging population, these demographic forces that are really deflationary in nature. Those have not gone away. And I agree, a lot of people miss that. We're not living like, sure, there's a new normal or whatever, but all of those demographic factors remain the same. We're still developing technology that's going to make things cheaper. We were just talking with Addison, why are TVs so cheap now? Well, technology's made them cheaper. Again, we talk about phones all the time. I mean, this is a computer, it's a video camera. This would have cost $5,000. All of these things in this phone would have cost $5,000 to $10,000 in 1995. It's 2021, and I can buy it for all this stuff for $1,000. So there's all these deflationary effects. But to say there's no inflation, to counteract that is it's just not correct. So I think we're going to see continued lower rates for longer. He did indicate that they are thinking about having 2 rate hikes between now and 2023. So it's about 2 years that they may bump the Fed funds rate. Let's all just keep in mind, they don't raise like the 10-year treasury. They don't raise treasury bills, although they can affect them by purchasing those securities. The only thing they're moving is that Fed funds rate, which is now between 0 and 0.25%. So Matt, sorry, I went on a little bit of rant there.
No,
Any
I
other
wanted to
thoughts?
I wanted to reemphasize, and I did, make that oblique reference to a modernist poetry, but it is, so much is subject to interpretation, and it was very interesting speaking with you yesterday when this was announced, and reading the headlines, you would expect that they announced imminent rate hikes,
I know.
but really no, they were thinking about it, or talking about it, and they are just reading so much into what was essentially, in terms of action, nothing big's going to happen in the immediate future. So
Yeah.
I just wanted to note that.
Yeah. No, I think that's a good point. And because if they said they weren't even able to think about it, that's just tying their hand behind their back. They felt like they had their hands tied behind their back because they said they weren't going to do anything. They at least need to say, look, we're paying attention. We don't think we need to do anything, but obviously, like, we would do something if we needed to. Like, that's what they were saying. But what they said for certain, what Jay Powell said is, we are going to continue buying, $40 billion worth of treasuries and $40 billion worth of mortgage-backed securities every single month to maintain liquidity in the markets. And so those mortgage-backed securities, those are real estate loans, mortgage-backed securities, that's for commercial and residential real estate. That is going to keep liquidity pumped in the markets for even longer. And we are hearing anecdotally from brokers across the spectrum, from agency lenders, HUD lenders. These lenders, they are awash in capital and they are ready to lend. The money is out there, which again, it does pose a concerning question of, you can't overheat the market like that, and maybe the right decision is to pop it in a slightly lower gear and kind of just slow down a little bit, because I keep thinking, everything just opened up in Indianapolis, Marion County, where we're located. The full mask mandates kind of went away over the past week and a half, 2 weeks. Outside of the city, they've been gone for a while. But the real opening up that's been going on, it's really starting to happen now. I don't know if you can feel it, Matt, but there is a change in people's behavior. They're getting out and saying, all right, I'm ready to do something. And that economic activity is directly related. And so we've been heating up. It's going to get hotter. And the way I've been looking at it since April, May of last year is, again, they're just dumping jet fuel all over the ground and just waiting for economic activity to light it on fire.
Yeah, I was listening to CNBC earlier this morning, and Arthur Cashin from UBS was talking about how a lot of the price increases and the inflationary pressures that we're seeing now are on the supply side, and we really haven't started to see the demand side really affect this. And so if both of those meet, then we're gonna have a little bit more of an immediate problem when it comes to inflation.
Great point. No, great point. Yeah, we've seen the supply side, but what about demand? Excellent point. All right, let's just jump right into rates and market. Let's get to some specifics. Okay, so let's talk about the U.S. 10-year Treasury yield. Last night when we posted this, it was at 1.5%. Again, that's a little bit down from where it was. But let's take a look at actually the chart. We're clocking in, this morning, we're down below that 1.5 marker. We're right at 1.48. But we did spike up just below the 1.6. Yesterday. Again, this was so you can see this. I mean, this is the markets in motion right now. Go to a five-day chart. So we were basically hanging around right below 1.5% on the 10-year Treasury. So right at what is this? This is right at 4. So this is right, I guess, at the no. So 8. So this is right before the press conference, right before he gives is giving his remarks. 10-year spikes, and Treasury yields aren't supposed to be super volatile. I mean, it's not going up that much, but so right before the meeting, bam, spike. You see an increase of yields. That means people are selling Treasuries because an increase of yield means prices are actually going down because you're getting a better yield. But as you can see this, as his remarks, and we're dropping even further since we've even just been looking at this, as his remarks went on, basically indicating that they're not doing anything. They're not touching rates. And yields were declining during the entire press conference, and they just dropped off. And they continue to drop off. Now I'll move to a one-day chart. As we're speaking, we're at 1.475. It's continuing to drop. We're at 1.472 again in real time. 1.47.
Exciting.
And this is real time, just on the freaking 10-year Treasury notes. So this is pricing in lower rates, and potentially tighter spreads between the 2-year Treasuries or the shorter maturity Treasuries. Because again, the federal funds rate, that's like the shortest term rate, or they adjust like lending over the overnight window. These are stuff going to the big banks, basically free money essentially. So it's fascinating. The Treasury yields are going lower. That means it's going to be even easier to finance real estate and other capital purchases, and that's why investors are allocating themselves to more value-centered investments, investments that utilize leverage, utilize real cash flows, and are more tied to the actual economy, less speculative. And multifamily real estate is one of the best examples. Commodities can track inflation maybe a little bit better, but you're not getting any cash flow from buying gold or copper, although it could be a great tool for the portfolio. So anyway, enough on the 10-year Treasury. Let's get through the rest of rates and markets. But obviously, we've talked about inflation. We're talking about the Federal Reserve. Have to talk about that 10-year note. So the 30-day LIBOR, again, inching down a little bit further. We're at basically 0.08. LIBOR, it's being phased out. Talk to your banker. They're getting rid of the LIBOR. Some banks are still using it, but it's going away. But we still cover it because a lot of loans are still based on it. SOFR, that's what supposedly is replacing it. We've done a couple of loans of SOFR. It's essentially zero. You're basically just paying whatever your lender is charging on the spread. But the spread between the 10-year Treasury and the 2-year Treasury, it's coming in at 1.36. It's a little bit tighter spread than we've seen in recent weeks. Now for HUD interest rates, these are housing and urban development loans used to finance multifamily properties. The HUD 223F loan, that's for stabilized existing assets, 35-year terms, 35-year amortization. It's a fully amortizing loan, but very low interest rate at 2.35%, although you do have to pay a couple basis points of mortgage insurance premium on those HUD 223Fs. HUD 221D4, and these are for new construction, new projects. These are 40-year terms, 40-year amortization. That's clocking in at 3% right now. Now let's look at some of the agencies. Fannie Mae and Freddie Mac, right around 3%. Again, this varies wildly whether you're looking at a 5-year term, 7-year, 10-year, adjustable rate, fixed rate, how much interest only, what kind of sponsor you are, what location. But we're clocking right around 3%. We're looking at a floating Freddie floating product closer to the 2.6% range. But so think 2.6, 3.10, somewhere in that range. Lenders right now, because of all this liquidity we've been talking about, are getting very aggressive. So it is a great time to lock in some debt. Inflation destroys debt. The value of those dollars, that loan, is going to be going down while your rents are going to be increasing. That's a part of why we love the multifamily investment thesis. Now, at the broader stock market, S&P 500 coming in at 4,223. The stock market is near all-time highs. Slight pullback after the FOMC meeting. Not surprising, kind of a sell the news story, I'd imagine. iShares residential ETF, RES, coming in at $83.54. That is an ETF that tracks different residential apartment REITs. Gold coming in at $1,824 an ounce. The steel index, we've been tracking commodities. Steel coming in at 1,766. Yeah, so we're looking at steel, and like some other commodities like lumber, we have definitely seen a decline. This is a 1-month chart, Matt. We can go back 3 months. We saw the big spike here back in April. Then it started declining. We were really around April, and has been kind of a slow decline, a little flat, but definitely to the downside. But if you again look at this big spike, we're kind of halfway there, and so just my non-economist in me saying like, okay, this is going to be. That's a meaner version, right? You go up and okay, maybe it's not that high. Let's figure it out. Okay, we're right about at equilibrium. I can't say that word. But so that makes sense. And now let's just compare this to lumber, though. That's the next ticker that we tend to track on the Gray Report. So let's look at a 3-month chart as well. So again, let's see. Yeah, so about in May, The 10th of May was when lumber peaked, and we've been on a very steady decline. Let's go out to a 6-month chart. I need to get a little bit more perspective. Man, talk about, full correction.
Yeah.
Because we were discussing a couple weeks ago, you're seeing articles now saying, "Oh, lumber's dropped." We were talking about lumber dropping a couple weeks ago because we had mentioned, I think it was 2 or 3 weeks ago on one of these videos, we were talking about lumber had gone through a mean reversion right about this point, kind of early in June, but we've gone all the way back down. We're at the lowest levels we've seen since March of this year, of March 2021. So that's not that far back. Let's look at a 5-year chart, which again, this is just crazy. So we're at the same point that we were, March 15th. So, it's not like it's come down that much. And okay, I'm sorry. This is why perspective is good, because if we looked at the 1-month chart, the 3-month chart, it looks like, oh, wow, lumber has lost all of its gains. It's back to where it was. But we got to look at this really 5-year chart. The 1-year chart doesn't really show it. The 5-year chart. Now, okay, this looks more of like a pattern. And okay, so this is the full run. We've gone here from March 2020 all the way up. And, and we started, breaking here, kind of this 1422 level. And now we're down to, the sub $1,000, 900 level. And that's kind of, halfway up, starting, down here at, it's maybe halfway through here at 373. We peaked at 1741, and now we're down at 902. So, again, it's just a wider mean reversion looking at a larger period. So I think that's pretty interesting. Where it's going to go, I don't know. I know as much as probably most of you. I'm just looking at the chart. I'm certainly not a lumber expert, but it's nice to see, because I think these levels up here were quite unsustainable. For Maine developers.
A lot of projects are more viable now than they were a month ago, and I think that's great news.
Yep, absolutely. One, I guess, story to continue to track, though, is crude oil. And again, comes back to this inflation story. But oil, we're a little bit down today, but we have seen oil increase over quite a bit of a period. I mean, look at this from November. We've gone way up. Let's look at a 5-year chart. From that trough back during the pandemic. We've basically kind of recovered, and we're back at the highs we haven't seen since 2018. So, oil is definitely, it's been pushing it. It's been pushing it, to say the least. And again, with the last two kind of metrics that we track, we're tracking cryptocurrencies and Bitcoin and Ethereum. The crypto markets in general have been pretty soft. Bitcoin tracking at 38,947 and Ethereum at 2,435. I mean, similar story. They're still way up compared to a year ago, but certainly down from the highs that we saw a couple of months ago. So it is what it is.
Yep.
Okay. All right. Let's we discussed quite a bit about JPOW's, the press conference, the Federal Open Market Committee. I think it was fascinating. If you haven't watched the press conference, it's worth watching. I think JPOW's pretty straightforward. Some good questions were asked. Some people kind of pushing him on the fact that okay, what do you mean there's not too much inflation, and at what point is going to be too much, and what are your concerns? And he had some pretty good responses. So I recommend hop on the newsletter and check out the video.
Yeah, I think as a function, it's important to kind of understand the function of what his speech was too, and what kind of constraints he was. This is and I was just looking back, and I guess the Federal Reserve used to not even talk about the rate hikes or tell anyone what they were really going to do. They just did it, but in the past, after the great financial crisis, they've been a little bit more vocal. But as they've been more vocal, they've realized they kind of have an ability to speak a reality into being. And with that great power comes comes a great responsibility. And I think that his measured tone, and this is what people were saying, is like the language that he's saying has gone through so many revisions and so many people that he doesn't want to tread into any kind of ambiguity that can be interpreted the wrong way. And a lot of people were saying it was a pretty good success. We saw these interpretations flying in both directions. But all in all, I think it was a very good speech that did a lot to assuage.
Yeah, no, I would agree with that. I think the kind of the goal, I think, was achieved in that they had to say something because they had to maintain their sense of credibility and to say like, look, we're watching this and we'll do something if we feel like we need to. But he's also basically saying we don't know, and we don't really we no one knows. And to me, that comes to the challenge of just the idea of the one central bank, and compared to competing currencies or other systems, is that you got basically one guy making some major decisions. He's unelected, he's appointed, he's completely unelected. There's no audit, there's very minimum oversight from Congress. I mean, he has to go in front of Congress and sort of explain what he's doing every once in a while. And he theoretically could be removed from the president, I believe, but it's pretty much an independent organization that can basically set the price of money. And we assume that they are need the smartest and all-knowing individuals, but they admit that they don't. And that's where I just, again, this isn't getting into the, idea of the Federal Reserve or central banks, but they don't know. And many of the bubbles, many of the crises have been caused from the Federal Reserve either overshooting, undershooting, or taking the wrong step at the wrong time. And he is very aware at all of the errors they've made in the past. Like we said, they didn't think that the economy could run hot without creating inflation last time around. They're basically saying we've learned that lesson. We're going to let it keep running hotter and get everybody a job, and not just get everybody a job, but we want to see wages increase. And until we really see wages increase, and then maybe we'll see inflation, okay, then we're going to downshift, power down a little bit. But, they're taking a very egalitarian approach, which again, makes sense and kind of, it makes sense from an emotional standpoint. You want to do what's right for people. But and again, we're talking about investing, we're talking about economics, and, bringing emotion and all these other mandates.
Yeah.
Mandates are full employment and more or less economic stability, and it's not necessarily making sure everybody's having a good time and everyone's taken care of. That's a hard mandate. It's very subjective, and he's kind of taken on that other mandate of, well, we got to do what we can to help people and take this social responsibility, which again, that's a great thing to want to do, but is that the role of the central bank? We have to ask ourselves that. And again, it just, I don't know if the problem is no one has the answer. No one has the solution. That's why markets are so incredible, is that it's the million micro decisions of individuals and entities and businesses that can find these solutions and make markets work.
I think you hit a nail on the head when, if there was one goal, it was trust us. And it's so important to build that credibility when it is just one person. A market, it doesn't have to be credible or not. It's just going to work. People are going to make a million different independent decisions, and there will be that kind of price discovery. But when it's one person making all that decisions, then maybe they need to go out and say something to the extent of trust us.
If someone is, they better tell us what's going on. Otherwise, we've given these guys a lot of power with very few kind of strings attached. So,
because without that trust, then, like you said, there is a lot of emotion, and things could go and things could go crazy.
Yep, absolutely. All right, let's get into the next piece on the Gray Report. And so it is CRE bankers are optimistic about the future. Well, they're going to continue to buy up. Well, the Fed's buying up $40 billion of mortgage-backed securities. So I can imagine why they are. Matt, kind of break it down. What is BizNow saying?
Yeah, so
why are they optimistic?
This article was written before the Federal Reserve News, a few days before that. And a small caveat here that this is a sponsored piece coming from the commercial bank Truist. So it's written with their interests in mind. And their interests, it looks like, are interest rates, as the article notes that well-capitalized borrowers, lenders, and by extension, the Federal Reserve deserve much of the credit for keeping CRE afloat. I'm not pro inflation, but this article is a good reminder that these low interest rates are really helping facilitate transactions and making more capital easily available to CRE borrowers. So there is,
For
as
sure.
much as inflation is a threat, yeah, the low interest rates that we are, they do serve a purpose. Obviously there needs to be a good balance there, but
Yeah,
that's the
I
benefit of it.
agree. And it's that the banks, well, the banks wouldn't mind interest rates going a little bit higher because that way they can charge more. They can get some yield a little bit. But the fact is, again, we're talking about raising taxes. Easier way than raising taxes is to print money and cause inflation, because that's going to destroy the purchasing power, and that's going to destroy the debt that the federal government has. It's making that debt much more insignificant compared to inflation, and they can inflate their way out of it. And I think that's part of the idea is let's get the economy running hot, let's give everybody a job, let's destroy the debt. And but on the flip side, if you're not allocated to real assets, and if you don't have debt that's being destroyed, the debt that's like purchase a cash flowing asset,
Yeah.
unfortunately, it's your purchasing power. Your wages are going to be the last thing to move. And if you're only relying on your wage and your W-2 income, that's the last thing that's going to be affected. And I hope it does. But the vast majority of Americans are going to be absolutely left behind because of this invisible tax of inflation. I mean, you've heard the Senate, they're not going to necessarily raise any revenue for infrastructure. They're going to print it. They're going to borrow from here, steal from there. They're going to inflate it all away.
Well, and that kind of ties in, and we're working on a separate video on inflation right now for Gray Capital, but it ties into the idea that inflation is it's an uneven process. There's going to be winners and losers, and that's kind of the big problem of it. If it was all even, then maybe we keep growing forever, but that's not the way it works.
Nope. That's a good point. It's not the way it works. And unfortunately, some folks are going to be left behind. It's all how you're reacting to all this. Okay, so multifamily in the economy, the bid-ask price gap ignores pandemic's upheaval. I think that is true. Globe Street, good article. What's going on, Matt?
It's a story that we've talked about here without kind of a specific article dedicated to it. It's a seller's market, and a lot of people are selling commercial real estate for high prices, and buyers are mostly willing to buy it. Now, I haven't noticed price increases on the multifamily side that come close to those in single family homes. And price growth in CRE is expected to be 4.2% for 2021 compared to the 5.1% growth in 2020. But I think that this is something that we're going to see, and this is an ongoing trend, and it is just worth mentioning that that there are certain sectors in which this is far more true than others. I feel like the 4.2% for 2021 is definitely not the multifamily market, and I'd love to know what kind of assets are pulling that number down, especially compared to in 2020 was 5.1% growth, which is pretty nice.
Yeah, I mean, we're seeing 5%. Properties selling 5% over the asking price, not 5% year over year. I mean, it's more like 20% year over year, and then 5%, maybe 5% on top of that. I imagine they're looking at a lot of commercial, a lot of industrial, a lot of commercial, a lot of retail, and then a lot of coastal real estate that has been beaten up. Again, it's very hard to look at a national real estate market because there's no real national. I mean, it sort of is, but there's the coast, they're overweighted to the coast, and other regions are underrepresented. So it's true, prices are going up without a doubt. It is a seller's market. Absolutely 100%. Okay, let's get kind of back into it. Real estate investors prepare for distress, but opportunities lag. This kind of gets to it. Want to buy something, but where are the deals?
Sellers aren't budging. There's a stand, and it says those words in that in the article. There's a standoff right now, and I'd be interested to know what kind of things would need to happen to shake some of these deals loose. The article noted that there's a time element here, which is kind of interesting to me because if a seller asks for a high price, the seller presumably will stand to benefit from that sale sooner rather than later. And if their property remains unsold, all those months of not having sold the property, that's not necessarily good for the seller. Now there's probably going to be a good appreciation, but maybe it's an empty retail property and the seller expects things to pick up. How long really is the seller able to wait? What conditions would make it, would make this time thing just keep ticking? And
Yeah.
I feel like there's,
Yeah, I think, if you've got a property that's not perfect, that's distressed, it's not stabilized, now is the time to bring it to market, because some people just don't care. They're trying to buy everything, and it may not be the case next year. But if you've got you do have the luxury of waiting if your property is stabilized and performing, because then it's a question of, should I, harvest the gains that I've made and take profit now, take it off the table, or is it going to be worth so much more in a year, 2 or 3 years, or have we already gapped up? And I think we've already done a big gap up. I think we're going to still see, linear price growth because of rent growth, but I think the big cap rate compression has probably already happened. But I don't see prices going down anytime in the near future.
And it's like, if they're waiting for the distressed sellers to sell, then maybe those properties aren't really that distressed to begin with.
Good point. Okay, so let's just hop in real quick. Apartment list, uncovering the best cities for remote workers 2021. I just want to touch this quickly, but because it's a lot of what we've seen in the past. Boise, Idaho, just everyone's going to Boise, Idaho. It's pretty incredible. I think, Matt, you had some opinion on they didn't really weigh affordability as much as they could, more remote friendliness. I'm not sure what that means.
Remote friendliness was a combination of the share of workers who are already working remotely in 2019, or those that have remote friendly jobs. I think that.
How is a city? But I thought that was related to the city.
Yeah, so the share of workers
okay.
within that city who in 2019 were either working remotely or had remote friendly jobs within the city. Now, I think that was weighted over high, and I think that affordability is almost twice as important for job opportunities for work from home renters. And this is the data that Apartment List has provided.
Mm-hmm.
I think the real upshot to this article is that people are mobile. And I know they may move more to the suburbs than to other cities, but post-pandemic, people are moving more than they were pre-pandemic, and affordability is the biggest issue for them. So that we're going to see more mobility. We may see people pile into a low cost of living area. Cost of living rises there, and then another market becomes more valuable. So this is a condition that will really reward keeping eyes open for opportunities for growing markets and for and for real deals. So it's an exciting time. So that's why I just kind of wanted to highlight that.
Yeah, no, I appreciate it. Okay, let's look real quick. Capital markets and the supply chain. Colliers, really interesting report, very solid. Let's take a look real quick. Uncovering opportunities in uncertainty, emerging trends in capital markets post COVID-19. What are the big takeaways, Matt?
Yeah, so it does talk about the top line. I would say is that industrial and multifamily assets, those cap rates are definitely compressing. CRE sales are increasing broadly, and digging into the report a little further on page 7 is some information on specialized assets like data centers and cold storage. These I think are particularly interesting because it especially in that they note the massive growth of e-commerce.
Yep.
And I have read very little that contradicts the expectation that e-commerce's growth is here to stay. E-commerce grew so much during the pandemic. I don't think it's going to go back down. I think it is here to stay. I think these investors are betting on that. And and it's a big part of the industrial growth and the increasing warehouse prices that we're seeing. And I know this is maybe skipping ahead, but to the commercial property executive industrial article, this article says that coastal markets are getting expensive and industrial renters are looking for inland markets, especially in the Midwest. Logistics is getting increasingly important, and that importance is, it's not just shipping, it's not just boats. There, the capacity to move products from point A to point B is incredibly important, and people are really starting to notice now.
Yeah, no, that's fascinating. Yeah, no, I think everyone in the logistics industry has probably had to rethink, or manufacturing has kind of had to kind of reassess how they're going to do business
Yeah.
in the future, and what's more efficient and what works. So I think it's all good points.
Yeah.
And I think this kind of gets to, in this article from NPR, how chaos is in the shipping industry is choking the economy.
Yeah,
It's true.
I just heard this morning that it was on the same CNBC show that that Home Depot has bought its own shipping container so that they can ensure that they get their products on time. And like you said before, I think that we are seeing the limits here of the just-in-time manufacturing model, where manufacturers cut down on spare parts because of reliable supply chains. This is kind of like, you don't notice it until there's a problem, and there's kind of a problem now, and logistics is so important. It helps keep the cost of prices down so much, and wait times and all of that kind of stuff is becoming incredibly valuable. And I think that that's really going to drive the industrial sector for some time. I don't think that I don't see it going down. I don't see this as a pandemic exclusive environment.
No, I think that's a good point. And like so many things, the pandemic just accelerated so many of the trends that were already going on, and just
and especially when you're talking with logistics, you can't produce logistics outside the country. Logistics is very localized. It's geographically dependent. You can't build a logistics factory. This is talking about warehouses and the shipping, the infrastructure that moves things to where you are.
Yeah, it's that last mile. Somebody's got to pick it up, drop it off. or figure out drones, which there's an article in here about that too.
Yeah.
But it's good stuff. Okay, so just quickly, because don't want these recaps to be too long, but there's too much good stuff. No, and it's too much good stuff. I went on, I think, 3 Federal Reserve rants. That's, maybe we need to. No, we just need some more time in the week. We looked at lumber prices suddenly moving downward. We've really discussed that. It appears to have some relief for developers. Hopefully at some point, as long as it continues. I saw an interesting article about, it was very localized. It was like in Fort Wayne, Indiana, being like, when are these lower lumber prices going to reach Fort Wayne? And I'm like, that's how attentive the entire population is to these high lumber prices. But just kind of the last couple of things we wanted to talk about. The NMHC rent payment tracker. This is something we're always tracking. We really started paying attention during the pandemic. It's down slightly. June is slightly down from May. We're only a little bit through June. They're going to kind of update. They always update it kind of at the beginning of the month when rent is due, and then at the end of the month, because some folks thought you either pay on time or you've paid your late fee and you're going to pay right before the end of the month. So they kind of track those two time periods. We're down a little bit from last month, a little bit down from 2020, but we're really materially, it's not incredibly changed.
Yeah, you don't see a progression. It's kind of noisy, but not volatile is what I would.
Yeah, I would agree. And they made a good point about how in June the 6th of the month landed on a weekend. And so those payments were, pushed till Monday. So they're capturing everything went through Friday, but rent wasn't due until Monday. Some people, again, just probably going to wait till that last moment, or at least that 1 to 2% that kind of moves the needle and is the difference here. So we're going to track this throughout the month and make sure there's not a trend. Something we want to pay attention to because, collections are certainly still down from their work.
Yeah.
In 2019. So we will keep you updated, but I would say no cause for concern. We're just going to keep tracking it.
Hey, Spencer.
in
Do we have time to talk about the Wall Street Journal article?
uh yeah. Sorry.
All right. I'm sorry. No. That's fine. I think that this is an article that you brought to my attention, and it's something that I didn't have time to put into the newsletter for this week. But if I did, I would have put it as the headline.
Well,
I
and
think
but it's
incredibly
going, but go over to hop over to grayreport.com. It'll be at the top.
Yeah. Well, I'll post that up right now.
Yeah.
Yeah.
So I don't have the article in front of me right now, but essentially, the Wall Street Journal reported on a research report from the National Association of Realtors that was commissioned by, who was it commissioned by, Matt? It doesn't really matter, but
Rosen Consulting Group.
Okay, Rosen Consulting Group, and basically the conclusion was we need about $5.5 million of housing units today. And over the past decade, since the last recession, we just have not been building enough units. I had the exact number of units on average we built every single year. But when they break it down, we needed, and if I'm a little bit off, my apologies, I'm just going off of memory, but we need about 2 million single family homes. We need about 2.5 million multifamily units. And then we need about another 500,000 to 1 million of, kind of duplexes to fourplexes, that kind of the 2 to 4 unit range. We need 2.5 million multifamily units. I'm just going to be speaking to multifamily. One, obviously, this is the data that we've been talking about that shows there's just a huge supply imbalance, huge demand for homes, and there's just not enough homes. We just haven't been building enough homes. We did a whole video on it, and talking about this exact stuff. But we need 2.5 million apartment units. When the peak of construction for multifamily units, which was like in 2019, it would have been more in 2020. It was around 300,000 units is like what we need to deliver every year. We need 2.5 million multifamily units, and a lot of those we don't need luxury apartments. A lot of them are more affordable units, which is why it's important to focus not on the high end, but also those that kind of B and C class renters by necessity who can't afford to buy a new home. And people say apartments going away, people want to buy a home. How many people can afford to buy a home? Who's got 50 grand in their bank account ready to put on a down payment? Some people do. Most people, unfortunately, do not. So this is really just underlying the housing crisis in the United States.
When just putting, we could say there's a housing crisis, but putting numbers on it, the fact that the housing deficit, that we need 2.5 million is 8 times the maximum that we've ever built in a single year. That's staggering, and I think that it really just it underlines it in a way that you can say housing crisis so many times, but
yeah, and it makes one think like you could just go out and buy any kind of type of housing, and you're going to make money on it. Now that's that's not a good idea. That's not like a strategy. It's not a tactic, but like, you could have done that the past couple of years and done pretty well. Again, you should just find something that works and the fundamentals make sense and you've got a business plan. But like, throw a dart at the board, see where it lands, and you buy it if it's residential housing. Make sure you're paying a reasonable price for it. Make sure it's in a good market. Make sure you have a plan. And maybe we're thinking it too basically, and comment below in this video if you're like, you guys don't understand economics, just supply and demand. You showed up for the first day of Econ 101, you think you got it all figured out, which we're joking about, which, we're not geniuses. I'm not an economist. Matt, you've got a PhD, but not
an economy.
Not an economy. So, but man, it looks like we need more houses. We don't have enough of them. And it seems like it's too basic. There's a lot of other drivers, obviously, that make it exciting, but making it pretty simple.
Yeah.
Okay.
8 times.
Eight times. Okay, everybody. This was an excellent Gray Report newsletter roundup. Matt, I really appreciate you being on. Thanks again. Looking forward to having you on next week. If you enjoyed this, if you got something out of it, make sure you subscribe to the Gray Capital YouTube channel. So hit the subscribe button. And if you hit the bell icon, it's actually going to let you know as soon as we post a new one of these. It's just going to pop up right on your screen. And you're just going to say, I'm in the know. I got to watch this video. And we apologize they're too long. We're going to try to work on making them a little bit shorter, a little bit more digestible. But think of it, you're watching your favorite your news programming. Don't even, so take the time, make yourself a nice cup of coffee. Maybe you're going to have like a bourbon or something. Whatever you do to relax, you're going to roll something up, whatever it's going to do. You're going to listen and understand multifamily real estate and the economy. To take the next step, though, and this is something you do every single day, is make sure you've bookmarked grayreport.com. Grayreport.com. What is it, you may ask? Well, grayreport.com, it is the premier multifamily intelligence aggregator. It's going to be keeping you up to speed on all of the happenings in the multifamily industry, real estate, and the economy. Just showing you a preview of it here. I'm up to date. Lumber prices move suddenly downward. I can look at the last recap, but there's videos, podcasts, all from, again, multifamily industry, other operators, people in the economy. We're covering multifamily news. Look at all this multifamily content. This is, you can say, so up to date. You're going to be the person in the know, whether you're an investor, you're working in the industry, you're just curious, all the stuff in one place. Macroeconomic news, other real estate news, very tightly curated, all the good stuff. We got market updates. I want to know what's going on with REITs. Here's the res index. We're at $83 a share. No, but I want to know about Avalon Bay. What's Avalon Bay doing? No, I'm more doing pretty well. A little dip. I want to know what Mid-America is doing. Okay, good to know. Crypto, what's going on? Crypto, a little rough time. But how about Doge? Anyway, check out grayreport.com. And again, if you're interested in viewing multifamily investment opportunities, GrayCapitalLLC.com. Join the Gray Capital Investment Club, the only way to view exclusive opportunities from Gray Capital. By joining the club, you're entitled to an unlimited amount of free investment strategy sessions, but they're not going to be free forever. We're going to start charging for our investment strategy sessions because they're in such high demand. They are packed full of information. We feel like our clients, our partners, our investors, they get a lot out of them. You don't even have to invest with us. If you're doing other stuff, we just, it's a brainstorming session, where you are, what your goals are, what's your why in real estate. And we'll even put together, again, completely free, a portfolio blueprint proposal that lays out, a trajectory and a roadmap of where you can take your real estate portfolio, what some of those returns might look like, where you can take your capital, where you can take it. Take that $50,000, $100,000, $1 million, $10 million, and multiply it over time. If you got $100,000, we want to turn that to $200,000 in, about 5 years or so, while you're receiving tax sheltered cash flow and income throughout the entire period. Not an advertisement to invest in anything, by the way. None of this is investing advice. It's all for education, but hop on over to GrayCapitalLLC.com to learn more.